Gold has surged over 50% in the past year. It is one of the best performing assets right now. But with prices at record highs, investors are asking, is it time to stay invested or book profit? To break it down, I am joined by Vikram Dhawan, Head Commodities and Fund Manager at Nippon India Mutual Fund. It is the largest gold ETF in India with an AUM of more than 30,000 crore. Hello sir, please tell us about gold. It has already crossed 50% return over the past year. So do you think it is time for investors to turn cautious, or according to you there is more room for upside?
Thank you very much for inviting me on your show. There is a global reset happening in across various cross section of investors and central bank, etc. Uh, you may recall that central banks have been diversifying away from dollar, relatively away from dollar and more into gold for past many years now, and we are seeing that trend being replicated in the in the private investors. So just to give you an example, even in the Indian mutual fund ecosystem, the percentage of gold and silver AUM put together is less than 2% of the total AUM. And in fact, middle of last year, as per some reports, the global investor, the managed money of global investors were either underweight or had negligible holdings of gold. So this reset is happening. It was happening for central banks for now quite some time, but this reset is happening on the mainstream investors. Till the time this reset happens, we will see these kind of markets. Now it's very tough to call upon when this reset will be over. But typically, these are all long-term trends. While some investors may have been lucky to buy into this bull market, but not everybody was able to, latch on to this, exponential price rise. So I guess we will see, this kind of markets at least in the foreseeable future. But again, nothing goes up in a straight line. You will see bouts of consolidation, bouts of correction. But till the time this reset continues, you will see similar kind of markets.
And also this festive season is going on and we are seeing this daily increase in gold prices. So have you seen an upsurge in gold ETF buying? How was the month of September for you and how is October going so far for you?
So, gold ETF flows, I mean, I don't want to go too much into the past, but if you look at the flows in the past few years, the flows in 2024 were 3 to 4 times of that of 2023. In 2025, we are again, we are still halfway through this financial year. But as of now, it appears this will be another year where the flows will be at least 2 to 3 times, at least, could be higher also as we go ahead, of the flows seen in 2024. So we are seeing exponential increase in flows, and which is understandable because of the reset, as I mentioned, which is going on. So so this has been something which is growing at a very fast pace.
Right. So what is your advice for those who have missed the rally? Is it still a good time to enter gold or should they wait now for a correction?
So, asset allocation or multi-asset strategies is still very, new for the mainstream investors in India. Just to give an example, if you were to compare the Indian markets with, let's say, Europe or US, where the allocations by investors into the multi-asset strategies or funds is a lot higher than what we have in India. And I think in India, if I'm not mistaken, the total percentage of AUM in the multi-asset funds in India is probably 2 or 3% or even lower also. So this is something which is catching up, which is understandable because we are a developing emerging economy, and typically what happens is that only when the size of the portfolios increase, only when the investor awareness and education increases, only then the focus is on endurability of the returns, what we call as risk-weighted returns, and not so much the absolute return. So I think this is something which is also helping gold, because we are seeing investors putting increasing faith into asset allocation strategies.
Right, right. And one important question is on US Fed rate cuts. So, how do you see the upcoming US Fed rate cuts if it happens, and geopolitical tension influences gold prices in the next few months?
So the macro data, whether it is US dollar or equity markets or bond yields or the Fed rates and all, they have become not that significant for the gold market, because the drivers of gold prices are a lot different in this bull run than the previous markets. The players are very different. The last bull market that we saw prior to 2000, um, uh, just before actually the great financial crisis of 2007 and 8, that was primarily driven by macro factors, by funds which were actually tracking gold, by taking views from what is the macros telling them. And the dominant players that time were investors. But in this bull market, the dominant players are now investors have become dominant player. But prior to 2024 till 2020 or 21 rather, for 3-4 years, actually the investment flows were negative into gold. ETF actually, global ETF AUM actually came down by 30 to 40% post COVID. So the drivers are different, the players are different. So, but again, why the rate cut in the US is important? Because US is running a record fiscal deficit of close to 7%. They have only run this kind of fiscal deficit either in COVID or in the global financial crisis or way back during the oil shock of the 80s. So anyway, their fiscal policy is extremely accommodative. And on top of that, if the monetary policy also is accommodative, which is again a very fertile ground for gold, not so much for the dollar. So I think to that extent, it has got an impact.
That's right. Also, as an investor, I want to ask a question. Like, there are so many gold ETFs there in the market, and their NAVs differ. So, how is the NAV of a gold ETF determined, and how, as an investor, I should choose an ETF?
So I think it is not just in gold. Any ETF you take, whether it is the equity ETF or debt ETF, since ETFs are launched at different dates, so the appreciation and the impact of the expense ratios and all, etc., will be different. So let's say a fund which is launched today vis-a-vis a fund which was launched 10 years back will have different NAVs. So that can be a bit confusing for the investors. But I think what they should appreciate and understand is that the SEBI regulations are very cut and dry. First of all, the gold ETFs in India have to be physically backed, fully physically backed. And when I say fully, SEBI only permits ETF, all types of ETFs to hold only 5% cash. So worst case scenario, any ETF in any gold ETF cannot hold less than 95% of physical gold in the corpus. So that is one thing they have to understand. And typically, what happens is that the larger funds, because the rounding off is less, they typically tend to hold higher allocation of gold vis-a-vis a small fund. So then in that case, the variation is somewhere between 95% to 99%. This is the broad range which the ETFs will hold physical gold. Obviously, the aspiration of every gold fund is to hold 99% or even higher. But there could be some practical constraint in completely holding physical gold, because you need some cash for liquidity and subscription and redemption, etc. So I think that is one thing they should bear in mind, that if the gold prices go up by X%, the ETF prices will have a similar rise in prices. And so that is why I think NAVs are immaterial, because as I mentioned, the funds will be launched at different times. Also, I think the change in duties at that point of time may also impact the NAVs, GST, etc., etc. So I think what they need to keep in mind is that Today, if you're buying a gold ETF, which is fully backed by physical gold, so if gold prices go up by X%, they would be able to participate in this gold rally or gold appreciation in prices. That's more important.
Right. And also you mentioned about it's backed by the physical gold, but in digital gold we have the option of converting the digital gold into physical gold. Do we have any such option with ETF? Like as an investor, if I have like 10 units or say 100 units of gold, does I have the option of converting into physical gold?
So, as per the SEBI regulations, investors uh, uh, having a ticket size of 25 crores or plus can come directly to the fund house. But let me tell you one thing, the biggest difference between digital gold and ETF is that ETF is a regulated, fund. When I say regulation means that it is regulated by SEBI. And what does regulated fund means is that, if there are any investor complaints, they are handled in the ecosystem and in the SOP and structure of, SEBI. And which theoretically means that 99.9% of your complaints, there will be a regulation addressing that. You don't have to go to a police station or you don't have to, run after your money if it is an unregulated product. So I think that itself, sets apart the gold ETF from other types of gold investments which are not regulated. Because I think it goes without saying that SEBI's mandate for the AMCs is very clear: is the protection of the rights of and the welfare of the investors, specifically the retail investors.
Right. So apart from gold, also want to understand about silver. It is also on a run at this point of time. So according to you, which looks more attractive, especially from a valuation point of view right now?
So both have got different drivers. Gold, as I mentioned, is more a hedge against the higher debt load of the world. I mean, today the sovereign debt in the world has crossed $100 trillion, and the overall indebtedness of the world, all debt put together, is about 350 odd $1 trillion, which is 3.5 times of the global GDP. So it is an antidote, and that is why the reset is happening. Because since gold doesn't carry any credit risk, so the antidote for a debt, uh, higher debt, or some sort of a debt issue, or I'm not saying a debt crisis is on the way, but the antidote for higher debt is one of the antidote is gold. The drivers for silver are very different. We have this very concerning climate change happening in the world. Just to give an example, for second half of this year, it is forecast that the global average temperature will be 1.5 degree higher than the long-term averages, which in economic terms mean could be anywhere between 300 to $900 billion per quarter of economic output lost, either due to higher energy consumption for cooling, or because of drought, because of disruption of crop cycles, or so many other things, geopolitics, and illness, etc., etc. So this is a very, very real issue, which it has still not become a crisis, but it still is an issue facing the world. And I think one of the ways to address this issue is to shift from fossil fuel to renewables. And the most one of the most popular and one of the most effective renewables so far has been solar, which accounts for roughly about 15 to 20% of all the silver consumption. So I think the drivers are very different. So I think as we go ahead, you will have to more focus on the fundamentals and the drivers, not so much on one against the other.
Right. And one last question to you is on the growing popularity of SGB, digital gold, mutual fund based fund of funds. So how as an investor I choose among these options? And of course there is an ETF.
Yeah. So I think if you are an investor, as mutual fund, we are more concerned and focused on investors who believe in wealth creation through capital markets. If you are of that category, then gold ETF ticks all the boxes. It is regulated. It is more liquid than the underlying market. It is safe, secure, and efficient. I mean, nowadays everybody invests through the app. So it is click of the button, whether it is ETF or digital gold. It is regulated. That's more important. Again, if you are buying gold for some other reason than investment, then I think it could be physical gold, it could be SGB, it could be digital, because it will not have that kind of liquidity which ETFs have. Even SGB also, while they have had a lot of popularity, but because of liquidity, they will not be able to hedge your portfolio. Uh, it doesn't mean that if there is a decline in risk assets, there is there's a probability that SGB may not be able to provide you that kind of a hedge because they are not liquid. Especially the bigger the portfolio, the bigger liquidity becomes an issue. So I think horses for courses. It depends upon what is your objective.
Right. Thank you so much, Mr. Dhawan, for those insights. Clearly, gold has been strong, but this is also the time for investors to be smart and balance optimism with caution. And thank you everyone for watching. Remember, gold isn't about glitter, it is about stability. And as Mr. Dhawan said, hold it wisely and it will shine in your portfolio too.